All right, I'm Jim Hawk. I am president of Hanover International. That's my day job, and my night job is chairman of the National Investment Bankers Association. This is kind of exciting for everyone because over the next day and a half or so, you're going to get a chance to meet a lot of people who can be very beneficial in helping you realize your financial goals as far as capital formation. So how many presenting companies in here? Just raise everybody, okay. And I'll ask this question tomorrow when the rest are here. I'll ask you how many here to, hopefully raise capital. And believe me, everybody should be raising their hand. And I don't care if you think you're cash, secure. If you're in the business of growing, you're always going to raise more capital, and you always want to be positioned for it. Okay, what we like to do, this is very informal tonight. This is kind of a give and take. We have a panel here, and I'll introduce everybody in a sec. And but the real key here is to address a few topics that come up when companies are raising capital, because as you probably most of you know, raising capital is the hardest job in the world. And if any of my clients are in the room, they've heard me say that. It's a methodology, it's a process, and you really need to know how to do it. Most companies make the mistake of spending way too much time and way too much money in trying to raise money. It's very simple. So if you really understand the procedures and what's necessary, the do's and don'ts, it makes life a lot easier, okay? So I've been doing this a long time. I've learned from the best. I was very blessed in that way. And the fun of it is the industry is consistently changing, and you have to change with it. And capital formation is changing. There's some really new, exciting ways to do it, but you got to be informed. So starting tomorrow, it's a big step because you're getting exposure. People aren't going to raise you money unless they know who you are, and you educate them, not in only what you do, but the opportunity of what you got going on. You got to do that. So that's your mission, all right? We'll get into that tomorrow when we have the general session. But now what I want to do is introduce John Heidenreich. John is on my board of directors of the National Investment Bankers Association. And John is going to kind of MC this panel. And we have a very famous person here, Danny Hughes. If you watch CNBC every afternoon, or 2 times a week? 2 times a week, or Fox Business with Neil Cavuto, you'll see Danny on as a guest commentator. Don McDonald. Don is a seasoned vet as far as independent research goes. And Trish Fullerton, she is really a dynamo in creating perception and image for companies. But let me first introduce John. He can go into that more, and we'll go from there. All right?
Great. Thanks, Jim. Thank you. Thank you. I think we'll jump right into it, but I'm going to start out with follow up what Jim was saying is, one of the things, particularly for the companies here, and I noticed that about two-thirds of you are private companies, and I'm sure how many of you who are here, is this your first rodeo, your first time you've been out to a conference trying to raise money at an audience like this? Okay, that's about what I would have expected. So one of the things that we always like to talk about is, how do you present yourself to an audience such as us? And so as a starter, even some of the businesses, when we see them, we're often kind of confused as to what are you really doing? And I'm going to start out, and we'll at least have the people introduce themselves, and then we'll come to Tricia, who will talk a little bit about how do you brand yourself, and back in the old advertising, how do you sell the benefits, not the features? But why don't you just introduce yourselves a little more fully, and then we'll get into that.
Hi, I'm Danny Hughes. I run Divine Capital Markets. I'm an investment banker. I've been in the industry for about 25 years. We raise capital for companies starting from some startups, very few, up through participating in syndicate with larger firms.
Hi, I'm Don McDonald. I'm the founder and CEO of Concealing Global Research. I've been working in the capital markets arena now for about 35 years. What my company does, help companies public and private increase their exposure to the investment community. And we do that primarily through research and also promoting one-on-one meetings.
Hi, I'm Trish Fullerton. I'm the founder of Brandicu. I actually have 15 years in the digital marketing and creative services industry. My background's in, developing creative and service marketing platforms for brands including American Express, NBC Universal, Time Warner, and now I help digital startups develop their brands online too.
So Tricia, while you've got the mic, why don't we move to how do particularly some of these younger companies brand themselves in such a way and try to get to the benefits and not as opposed to the features to present to the investment banking community. And again, many of these companies have been founded by some very brilliant people who we often see get caught up in the what it is, how it works, and what we really want to know is what's the problem you're trying to solve and how are you going to get it done quickly?
Yeah, for me, I think it's very important when you have a new product or a new idea to be able to articulate it in one sentence. If you're not able to do that, I think it's very difficult to kind of get people to understand what it is that you're offering, and it may seem a little bit too complicated. If you have that one sentence, it's very easy for people to get it and also be brand ambassadors for your brand because then they can articulate that to other people as well. I think it's also very important to tell a story. Just going back to what John was saying, what's the problem that you're solving, right? So you want to open up with a story and just say, like, what are the state of affairs right now? Like, what is the issue? What is that problem? And then what is it that you're creating that actually solves that problem? And I think that's very important to be able to articulate that story in layman's terms. I've seen a couple of decks where, it's very technical. There's a lot of copy throughout the story. And it's almost like you don't really understand what the benefits are of what's being created. So everything needs to be very simple. I like the term KISS, keep it simple, sweetie. And just have the ability to articulate everything from start to finish within, I'd say, my sweet spot is 10 slides, 15 slides at most. But again, I've seen some as long as, honestly, 50 pages. So you want to avoid that.
Pass it down to Don. You got.
What I'd like to talk about is a little bit about the capital markets today. The capital markets today, what's going on, and the environment, how it's a little bit different.
Okay.
Over 30 years ago, I think Jamie Dimon from JP Morgan talked about how you used to get 15 cents a share to trade a share of stock. Today, it's a penny. So really, the traditional capital markets is having a hard time because you have increased capital requirements, you have margin compression, research budgets are slashed, and also you have numerous investment banks are gone. So the street right now, it's a little different, or I'd say a lot different than it was years ago. But most important, what happens, a lot of firms now, especially in the small cap arena, do not have any research. And what happens is I think 80% of companies market cap under 125 million, 150 million, do not have any research. And if you don't have any research, you're looking at probably a 25 to 30% discount in your stock valuation. So it's difficult to get research. Goldman Sachs is not going to be knocking down your door right away, but it really is an important component.
Great. And then Danny, why don't we talk about some of the subjects as we start talking about capital markets, that assuming the companies have done what Tricia says they should do, and they've got a really nice presentation, they've probably got a really nice website, and they've been able to articulate, so then they come in and they meet you. So let's talk about some of the nuts and the bolts. What is it that you're looking for in financial statements and representation, maybe corporate structure?
Sure. Well, the first thing that I want to know is, what's your model? How do you make money? Not only can you articulate what you do and the problem that you solve, but how do you actually make money? And then why you and not someone else? In other words, there have got to be a number of other competitors. Why is your model different? How are you cracking the egg differently? I actually do like to see some technical information. I like to see that you know what what you're talking about, but I really like to see when either the CEO or the representative can get me excited about what they're raising money for and why they're raising money for that problem and that issue. With respect to financials, I absolutely want to see what you've done so far and some of the traction that you have had. So maybe some milestones. You know, we started in 2009. We brought in this piece of business in 2010. We, got clearance on X, Y, and Z in 2011. So I want to see that timeline and that progression to where you are now. I also want to see who your vendors are. Who's your lawyer? Who's your accountant? Who are the people who are key to your organization and why? What have they brought to the table for you? I too have seen 90-page long decks, which at the instant I open it, I look to see how many pages there are, and that's one of my yellow flags, I hate to say. But we get pitched all the time. We see a ton of different decks, so we want to see something that's short, sweet, but doesn't brush over things. There are key components to pitching an investment bank or somebody else who's going to raise you money, and there's a lot of different ways to raise money in the markets now with the Jobs Act and Reg A and all the crowdfunding sites. So you want to make sure that when you're pitching to an investment bank, you're understanding why you're pitching to them. What do they bring to the table that you think that is important to your business and how you can execute on your plan?
I'd like to follow up on that. Price Waterhouse recently published a study back in May of 2016. There were 3 rules. Let your CEO and CFO tell the equity story at the roadshow. Number 2, build investor trust with consistent and accurate information. And 3, focus on the equity story. And they said the fundamentals of an equity story that matters most to IPO investors, number 1 is differentiation. How well is the long-term growth story articulated? And then when I had a survey, they're ranking the importance about an industry, the 3 most important: barriers to entry, industry growth rate, and pricing power. Important considerations about a company: integrated products, solutions, or services, size of the addressable market, and market positions. And the second one is predictability. How confident are you on your business visibility over the next, let's say, 18 to 30 months? And number 3 is executive management experience. They want to know management has confidence and conviction, and experience and credibility, and facility with numbers, very important. As far as the finance team capabilities, red flag, lack of regulatory compliance, major red flag. And then you look at comp analysis, the most valued metrics: EV to EBITDA, EV to revenue, EV to unleveraged cash flow, price to book, and PE. Those were the key. And also board of directors, they want to look at the experience on public boards. And then, let's see, one last point, I think Barron's, had an article on some of the top portfolio managers in the U.S., and they said, where do you find new ideas? And they said 3 main sources: screens, conferences like this, and independent research.
Yeah, let me come back while Danny's got the mic to something that she mentioned I want to have a little more embellishment on. Is one of the things you talked about is how do you make money? And one of the things that we'll hear presentations, and we're about 2/3 of the way through, and we still don't understand what the business is. So what we like to hear is, in many cases, particularly with the technical companies, how do you turn the science project into a business? And I know for early stage healthcare companies that's sometimes hard to do, but let's get to some assumptions that, assuming that your drug was approved for marketing today, how do you sell it? So,
yeah, this is actually something that happens a lot, particularly in the biotech and even the medical space, where you have a CEO who is a doctor and world-renowned, and they, and I hope I don't upset anybody with this, but they can't articulate exactly what it is that the business is going to do because they're so deep into the science. That is an issue for investment bankers because we have to tell the story. We have to tell the story to investors who aren't going to get all of that stuff, and they don't have the time to learn it. So I think it's really important to make sure that when you are practicing your pitch and when you're actually putting it down on paper, that you make it very clear and have maybe an audience of friends and families who are going to critique you in a really honest way, that you're making it very clear about what your model is. Did I answer your question? Mm-hmm. Okay.
Another thing, and I'll pass the mic over to Tricia, another thing that I know that I'm going to probably see tomorrow or not see tomorrow is when I was prepping companies to present to anybody, internally, externally, and what I see is often, the companies don't tell us right up front why they're here, what do I want from you. And often, if there is a deal slide, it's all the way at the end, and everybody's standing here with these 3 lights here, and all of a sudden, by the time the light's red, they're quickly flipping through 6 different slides, like, and we're trying to sell stock, da 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 da. And Scott, who just left the room, is sitting here pulling mic out of your hand. So, if for you companies that haven't taken what it is to the second slide after the warning, get it up there. You want to address that, Tricia?
Yeah, I mean, I think the benefit of your product should be very far up front. Again, if you go back to telling the story up front, what's the problem and how do you solve it, that gets that out of the way in the first 5 to 10 minutes. I also think, practice obviously is very important. I think it's important to tell your story, tell the story about your product to someone who doesn't have that background. Do they get it? And how do you tell it in a way where it's regardless of whether or not you're, in the medical field, the finance field, whatever field is required to get all of the technical jargon, they should be able to get it. I always say, if I took your presentation and I left it in a random room and someone walked in who had no idea what it was about, if they picked it up and was able to still get that story, that product idea, you nailed it, right? And again, it goes back to that 5-minute, not even 5-minute, I would say 2-minute elevator pitch. You have to get people to understand what it is you're selling and get people on board and becoming brand ambassadors essentially for your product or your idea.
Okay.
John, see if people have questions. I want this to be formal.
Yeah, let me talk about one more thing, and again, particularly it probably applies a lot to the scientific and the biotech companies, and Danny talked to it a little bit, is that, the other thing is your board of advisors, and is so key. Again, for those of us simply, we're always looking through. So when we see, a doctor from an Ivy League school, that immediately says something. And one of the things that we always did at my prior firm was we've tended to focus on individual investors. And one of the things we would always ask was, is there somebody that can help the company? And we typically found that the people who helped the company, not necessarily the people who wrote the checks, but the people who could help the company in an advisor role had more to do with the success than somebody who wrote the check. Any of you want to comment on that? Don, maybe how to find those people, or, is it?
So a couple of things with respect to your advisory board and how well you know them. Make sure that they're vetted. Make sure that you've done background checks on your advisory board. I think that's really important because when it comes to raising capital and then the investment bank or your other advisors do that review and something comes up, that could throw you for a loop. I do agree with John that those people, it does say a lot if they've come from somewhere significant or have massive experience in your space. But I think it also says a lot if they've actually made an investment and written a check in your company as well. And aside from your advisors, your board of directors are really key too. In the world that we live in now, your board of directors needs to be diverse. You need to have a diverse group of advisors and directors around you. It's really key to your business's success, and it's key to the optics of who you are out there in the world. One other piece that we didn't really touch on is valuations. You're going to come and talk about how much you want to raise. Well, what's your valuation and where are you getting that from? Have you raised money before and that round was at a certain level? Or are you pulling that number just out of the sky? That is really, that's a question I'm going to ask you. and it's a question anybody who's raising you capital is going to ask you. It's really key to have a third party do a valuation, and there's different kinds of valuations out there, but I highly recommend that valuation be done, because that sets the stage for what's going to happen when you go around and get term sheets or you talk to investors.
Yeah, no, I think the issue of board is really significant, and I'll talk a little bit about a company we were involved with, that not only the board, but who your professionals are. And the board was made up of the founder, the hired CEO, and the founder's cousin or brother-in-law, who was the lawyer that they used. Well, he was not a securities lawyer. He was a local general practice, and he did real estate closings. Now, this gets to some of the more seasoned companies, particularly the ones that are public. It doesn't mean just because you're public that things were always done right. We happened to do due diligence. The placement agent counsel went through and found that the company had issued a series of preferred stock, but never registered the certificate of designation with the state they were incorporated in. Now, those of you who are lawyers, I see you're starting to hear a couple of chuckles. Why? Because the lawyer they hired was not a securities lawyer. They cut corners, they saved money, and in the end, we walked away from doing the raise, and they probably spent at least $50,000 hiring someone to fix the problem. So, these are some of the things that we have seen, and we can all talk about, nightmares, but there are no independent directors, and that's really a key. But at this point, anybody have any comments, or shall we open for questions? Say who you are.
Richard Greenberg.
And who are you with? I'll repeat it.
Maravin.
Maravin? Okay. So Richard Greenberg, who is with Maravin, is a presenting company.
That's correct. We were told to wait on board
Jamie.
of directors till we have.
Just gotta-
I'll wait for the mic. Is that what you want?
Yeah, we'll do that. Is this on? Is it on? There.
How early in the process do you think a board of directors versus just a board of advisors comes into play of fundraising and developing a company? Do you think it's day one, or do you think it's something later as you further things along?
Jamie, why don't you bring the mic back up? Personally, I think you've got to have a board of directors, I think, before you come out and start raising money, because it's the signals, some of it's the optics, but also it shows that you're serious and that you're real.
I would agree, and I think that some states require that depending on the type of corporation that you are. And even if it's two people who are involved in the company and an outside director, I think it's really important.
Let me clarify my question. It's when you need a more serious board of directors than my cousin,
Well, you might have that on the sheet as this is who we've targeted to be part of our board of directors once we raise the money. So it's
Yeah.
something that we're going to ask.
I mean, and that's, again, one of the things that in the discussion with an investment bank, or, we haven't addressed IR per se, but, these are things that investment banks almost every meeting we have, and I see a couple of my colleagues in the back, we say, okay, we're going to call this guy, we're going to call that guy. So these are one of the things that your placement agent can also help you through their network, and we're really happy to do that. Steve.
John, we're a small boutique firm.
Hold on, Steve. Here, Jamie, you're the mic
And we
runner.
sit and attend a lot of these conferences.
Hold on. No, we need to run it back.
In your estimation, so for early venture deals and startup companies, what do you think is the ideal time from the very conception to getting through, say, 2 rounds of funding and actually getting to an exit strategy, whether it's an IPO or a merger? What do you think today's marketplace is time-wise?
Hold on, wait. We only have one mic, so we'll wait for it to come back up. My personal opinion is I think companies, in their own mind, probably are waiting longer for the, going public is one thing, but for a company that may stay private, it's tough. I mean, it's tough. I mean, I have a few shares in a company that I know that there's an offer on the table. It's half what the company thinks the company's worth, but it's healthcare. They haven't completed phase 3. They're halfway through. It looks good. So, is a double from today better than, oops, what if it doesn't work? So, but I'll let
John, let me, you're seeing, can you hear me? You're seeing a lot of private companies raising capital. It used to be, and I'll just say it, a lot of guys would say, oh, they got to get public, they got to get public. Quite frankly, that's nonsense. You're seeing a lot of bigger guys, strategic guys, coming in and taking, especially in Silicon Valley. I mean, Seiko, you can tell the stories about how many technologies are taken over in an early stage by some of the big guys, Google, Microsoft, whoever. Biotechs, now you're seeing a whole different game. You're seeing some of the bigger guys coming in, they're not even through phase 2 or so of the FDA, they're getting taken out. So I mean, it's all different as far as industry sector and where you're at. And it's all a matter, I said before, it's about positioning, okay? You just don't know. But that old, they gotta go public. No, you don't, okay? Is it an option? Is it an exit? Is it a way to utilize treasury stock to acquire strategic companies? Sure. Did it for many a year. But you gotta know, you gotta be ready for something like that. Am I making sense, Danny? You'd be,
Yeah. It's a really different environment now. Back in the late 90s, like when eBay went public, they went public and raised $75 million. Now, you don't go public unless you're raising, $500,000 or $250 million, because that's where you get traction in this market. Sorry, that's where you get traction in this market. I think a lot more companies are deciding to either do the Reg A route or the crowdfunding route, or stay private longer. And private equity and venture capital have big wallets. And they actually are writing bigger checks now. I don't know why this is kind of like a boombox right now. Sorry about that.
Scott wanted to replace the batteries.
But it is a different environment, and it really does depend. I mean, I think it depends on what's hot, what technology is hot, who's running the company. There's so many different variables. But one of the things I think that's part of my job is to say, okay, this company exit probably is not going to be, in a public way, but maybe they can get bought in a couple of years or something like that. So that's part of the process I think that we go through.
You also, if you're thinking of going public, you have to remember one thing. It's not a sprint. It's a marathon. And you have to also understand what the street is looking for, what's hot, what they don't want to hear about. And if you do go public, you have to go public the right way. You have to have your name and your story out there, and people have to know it. And if you're going out there, nobody knows who you are, you raise some money, and still nobody knows who you are, you're going to sit there and languish. And then, sorry, you became public.
Tricia, you want to talk about strategies? You want to talk about strategies that you would use to get companies' name out there? And again, you haven't come from a traditional publishing industry that is very quickly shrinking. So how do these companies use the new technology?
So I would say, definitely for me, social marketing is the biggest thing. I've seen a lot of companies develop social marketing strategies that aren't very strong. I would say the biggest challenge with that is overextending yourself. So, if you're a new company and you're trying to attack Facebook, Snapchat, Instagram, all of that stuff, it actually takes quite a bit of money to create the right content to engage consumers on that platform. I would limit yourself to one platform and just focus on that if possible. Again, creative and marketing messages need to be as tight as possible. Again, that one sentence, what's the sell? And then there's also research as a part of it. So as you're developing a campaign to get your name out there online, how are people responding to it? Are consumers actually connecting with it? And then just going from there. Yeah.
Okay. Any other questions from the, if you can,
I talk pretty loud, so you'll probably be able to hear me.
good,
This way, but this lady's going to have to answer it.
okay.
So, I've spent 15 years and $40 billion doing mergers and acquisitions of public companies. The tools for valuation of these companies are pretty straightforward, and they're very well defined. But in startups and in tech, emerging growth companies, the tools don't exactly apply. You don't use those EBITDA multiples, you don't use those revenue multiples, but how do you, what tools do you really use? Because when you're working in a $15 to $20 billion market, addressable market, and you have no competition, but your revenues are $2 million, how do you value a company like that?
Yeah, it's a good question. You know, I'll give two examples. It goes back to the late 90s. All these internet companies, you know, all of a sudden you couldn't figure out how to value them, so you came up with a new metric that was called the eyeballs. It's even better. A week or two ago, I was watching an old movie, one of my favorites with my daughter, called Shampoo. And if you recall the scene, Warren Beatty's going to the bank to get a loan to open up his own salon. And, you know, the old state Beverly Hills banker wanted his financial statements, a tax return, and he didn't have it. And he said, listen, I have the heads. And the banker said, what do you mean I have the heads? He says, I have the heads. And that was his metric. But
and you're absolutely right. There is no DCF methodology when your addressable market is fairly huge and it's a new space that you're in. But I would say that everybody has competition in one way or another. But what we like to do is we use a weighted average of a number of different methodologies. And some of them have to do with private company multiples. So in other words, if we can pull data on private company revenues and any kind of P&Ls or anything like that, we'll use that. We'll use M&A. We'll use, you know, what transactions were done in a period of time in that space. And public company multiples where we can pull out subsidiaries sometimes without address that market. And then we'll use a number of other pieces, and we'll weight each one of those in order to come up with a valuation. Because you're right, it is challenging to get a valuation for a company that is newer in a space or something like that. So that's what we do. I mean, I know that there's a lot of you know, robo-valuations that are out there, and those are mostly used for your options. And they're going to be a lot lower than a valuation that an investment bank does, or you know, when you're going out there and raising money. But I hope that helps.
hey, John.
Still have a minute?
Sure.
I used to scream and yell.
Just make sure the green light's on.
Hi, all. I used to do this for a living in this very room with a lot of people that are in here, especially the old guys up here, like John and Jim. But anyway, the way we used, everybody's the same now as they were before as far as trying to pick a valuation for their own company. It's their baby. They believe it's worth, you know, God knows what, and it's not. We used to put a lockup, and you can still do it today, on the insiders. We'd put a lockup on the officers, directors, shareholders above 5%, whether they came in before the deal or a long time ago. And it would get the entrepreneur to be more realistic about what his company is worth. We put a lockup in that the price of the stock had to trade at some premium above the offering price for 20 consecutive days before any of those insiders could sell. And we would not do a deal if everybody that fit into that category of the officers, directors, and hangers-on did not sign the lockup. And the lockup was for 5 years. So all of a sudden, you've got an entrepreneur that says, okay, as soon as I get public, I'm going to be worth $1 billion. It's not happening. So they come to the realization, and I've done deals with Jim and some other people in the room here. These insiders come to the realization that maybe we're not worth 50 billion or 50 million or 25 million, but we don't raise 20 million at a clip. We raise anywhere from 5 to 12, 13. That was our sweet spot. And the insiders, if they didn't agree and didn't sign a lockup, they didn't get a chance to sell. So realistically, if I own a company and I started it from scratch and I wanted to see an exit at some time, I would agree to a lower valuation because I want to get out there. We're not raising a lot of money, and if I'm successful, everybody will come back to the party. Everybody will have a successful investment with the company, and they'll come back and do another deal and raise a lot of money. We were very lucky with the partners we had for many years. I think there were probably 42 or 43 or maybe 44 deals that we did with this group and through my firm, that we had a better track record than Goldman Sachs because they wouldn't care. They just wanted to raise the money and get the big bucks in for the companies to take a shot at it. So from a performance standpoint, I'm sitting next to Jim Twiddell. We got involved in a company that went from nothing, through the roof, and then it kept on going. So it's a matter of a lockup. It's a matter of finding the right strategy. It's a matter of everybody being on the same page and not succumbing to the desires of the insiders and the founders of their company. They got to believe it, otherwise it's not going to happen.
Good points. Scott's going to change the batteries. In the meantime, Max, why don't you just come on up? Yeah, Max Terhune of Drexel Hamilton. Go ahead.
No, just a really quick point. At the end of the day, you come out with a range for a reason because you're worth what investors are willing to pay for it. It's pretty simple.
Yeah. Good point. We have a question all the way in back. Maybe if you could speak loud enough, the audience can hear you. And then.
I'll try. Just working the comment that gentleman said. I run public companies both in the U.S. and Canada, and the national instrument in Canada actually locks up automatically entrepreneurs in an offering. So you'll see a 3-year, under the Tier 2 escrow rule, you'll see a 3-year, 10% closing and 15% release every 6 months. But that's so, we've seen that through all our deals, where we look at lockups automatically based on the Canadian Tier 2 rules.
Yeah, here I don't think there's any rules, but you'll often see, in an offering memorandum, whether it's an IPO or a PPM to either a reverse merger or some kind, it's typically the agreement is made between the officers and 5% shareholders and the underwriter, but at least they're on record memorializing to the investors in the offering that they'll be locked up for typically 180 days. Mm-hmm. All right, any other comments or questions or any other comments from any of the investment bankers or attorneys in the room? Are we? All right.
Good job. Thanks, John.